Okay, so this is chapter 19. And so 19 is based on cost behavior and cost volume profit. And so essentially what we're going to be doing is we'll just look at the relationship between fixed cost, variable cost, the quantity produced, and the profit that we make. And so a fixed cost, that's going to be something that doesn't change based on quantity. So let's say we're going to make and sell t-shirts. And so we rent a space. And so the rent related to the building for this, that's going to be a fixed cost because it doesn't matter how much we produce. Whether we make 0 t-shirts, 100 t-shirts, or 1,000,000 t-shirts, the fixed costs aren't going to change. And variable cost, and so that's going to be anything that is going to go up based on the number of units that we produce. So if we have, say like the blank t-shirts that we buy that we're going to print on, for every t-shirt that we produce, we have the cost of buying a t-shirt. So that's going to be variable cost. So with things like, the ink for the shirt, maybe the actual screens that are used. You guys get the idea. And there's also mixed cost, and so mixed cost might be something that has both a fixed component and a variable component. So an example of this one might be something like maybe we lease one of the screen printing machines, and maybe the terms of the lease are, okay, it's going to be $1,000 a month plus $1 per shirt that we create. So in that case, we're going to have both a variable and fixed portion of that. So we're always going to pay the $1,000 no matter what, plus a variable portion based on how many we make. So lots of different kinds of cost. So let's go ahead and jump in to example 19-8. And so 19.8 is talking about a high-low method. And so what we're going to do is, there's going to be situations where we're going to know the total cost, and we're going to know, the activity that drives cost up. And we need to break that out between figure out, hey, how much of those total costs are fixed and how much are variable. And so here we have something called the high-low method. So in this example, we have a railroad decides to use the high-low method, and so it says that our activity is going to be gross ton miles. And then for the information, so we have several months. We have January through June, and we have the total cost related to that month, and then the total miles that were driven. Or I don't know, is that the official term for railroads? Do railroads drive? Anyway, the first thing to do is we want to identify, okay, what was the highest month and what was the lowest month. So those are highlighted here. So February was the highest month with the most cost, most miles. May was the lowest month for cost and miles. So in order to figure out, hey, how much of this is fixed and how much of this is variable, first we need to figure out the variable cost per mile. And so what we want to do is we want to take the difference of the highest month cost and the lowest month's cost. And so that is going to be the total variable cost between these two. So what we've done is we essentially eliminated the fixed portion. Now we want to figure out the difference in miles traveled. So go ahead and we divide these out. And so the difference between these two is going to be solely based on variable cost. And so we figured out that we now have for every gross ton mile, the variable costs are going to be $2.10. So we've isolated the variable cost component. And so now if we want to figure out how much the fixed costs are, that's when we go into this high-low method. And so we have a formula for cost, which just says the total cost is going to be equal to the variable cost and the fixed cost. And in this case, the variable cost is going to be the total miles, variable cost miles, which is going to be our 210, and then the total miles that we actually went. And so what we're looking for here is we want to figure out the fixed cost. So the easiest way to do this is just go ahead and rearrange our formula. And so this formula just rearranged to solve for fixed cost. So fixed cost is going to equal the total cost minus the variable cost. So, and whether we use the high numbers or the low numbers doesn't matter. We should get the same one. So we'll do it both ways just to make sure that it works. And so first we want to plug in the variable cost per mile, which is $2.10, and then the total miles. And so we're using the high numbers. So we go over here and say, okay, February was high. They went 1 million miles. And then we want to plug in the total cost. So now if we use our formula here, which is the total cost minus the variable cost, which is going to be our 210 multiplied times the number of miles, we get fixed cost of $600,000. All right, now let's go ahead and use the low numbers just to make sure that we're doing this right. So the variable cost per mile is 210. The total miles for the low is 400,000, and the total cost is 1.44 million. So now if we take our total cost, subtract out our variable cost, which is the 400,000 times the 210, 600,000. Perfect. They both match up, so it looks like we did it correctly. So, all right, so then on the next one, we're going to do example 19-10. And so 19-10, we're going to work on the contribution margin and contribution margin ratio. And so what the contribution margin is that's just saying, hey, when we sell something, every time we sell something, how much is going to go towards fixed cost? So the formula for contribution margin is, you can see over here in part A, is this our sales minus our variable cost. So if we have something that we're selling for $100 and it cost us $25 in variable cost to make this part, then that means $75 out of every single sale will go towards covering fixed cost. And then as soon as fixed costs are covered, then we start having profit. So the idea of contribution margin is really important and really handy from an analysis perspective. I really do love this chapter. I know the first couple ones as far as process costing and job costing, some people love it, some people hate it. I understand that, but this chapter is, as far as cost analysis, is really a lot of fun and really useful no matter what you end up doing. Whether you end up going into accounting or any other type of business, you want business of your own. I mean, it doesn't matter. I mean, the ideas of contribution margin, understanding your cost, break even, which we're going to do, is just really important and just really fun. So, or maybe I just need new hobbies. I don't know. So in this problem, we have McDonald's. It gives us some information, which I've entered in over here. So we have little income statement information. So we have the sales. This is 18 billion. Then we have some costs: food, packing, payroll, occupancy, general. We have a net income of 933 million. So just move this information over to Excel so we can actually work with it. Then what it says is that, hey, out of these costs, it tells us that the food and packing and payroll are going to be all variable, and 40% of the general selling administrative is going to be variable. So I've already gone over here and marked the ones that are at least partially available, entered in what percent they're variable, and to get our total variable cost. So we have total expenses of 17 million, 12 million of that is going to be variable. And so the first thing it asks us to do is calculate the contribution margin. And so that's just, contribution margin is a lot like cost of goods sold in a way, in that cost of goods sold is going to be sales minus everything that's all of the expenses that are related to the product. So contribution margin is the same idea, except it's sales minus just the variable cost. Because within all of those cost of goods sold items, there's going to be fixed and variable portions. Where contribution margin, it's just the variable cost. So we take our sales, 18 billion, and we're going to subtract out our variable cost, which we've summed up over here, is the 12 billion. So that means we have a contribution margin of 6.5 billion. And so what that's saying is that out of this 18 million of sales, we have 6.5 billion that's either going to cover fixed cost, and then the rest of it's going to go to profit. Now, if a contribution margin number is ever negative, that's a really bad thing. That means no matter how many you sell, you're going to lose money. And so you always want your selling price to be higher than your variable cost. And so part B, so we have the contribution margin ratio. And so that is simply, we take our contribution margin, which we calculated, and we divide that by our total sales. So we get 35.5%. And so what this means is that for every dollar of sales, 35.5 cents are going to be available to cover our fixed cost and to go towards profit. So this is a very useful number in kind of doing analysis. And so in part C, we'll be able to see this. And so it says, hey, what if we increase sales by $900 million? And asks us, so if we increase sales by 900 million, how much is profit going to increase? And so to figure this out, we just take the additional amount that we're going to have in sales, multiply this times our contribution margin ratio, gets us $319 million. So if we sell an extra 900 million, we'll be able to put an extra 300 million into our pocket as profit. That would be assuming, of course, that in our original example that we've already covered the fixed cost, and we have. So there's already profit. So that means in the original scenario of 18 billion, fixed costs are covered. So, all right. So let's jump on to the next one. And this is break-even sales. And so what break-even can be in dollars, break-even can be in units, break-even can be in sales. What it's saying is, like, how much does it take where I don't lose money? And so that's a really important number to know. If you're in any kind of business, the one number, if you have to know, if one number is important to you, it's what is your break-even? How many do you have to do to not lose money? If you're going to go back to our t-shirt example, if we know that, hey, we have to sell 10,000 shirts in a month just to break even, but we know that, hey, the max we can sell is maybe 7,000 or 8,000, that means, hey, there is no way to make money. Let's figure it out. Let's do something else. So understanding what your break-even point is really, really important. And so in this situation, so we're selling a product for $160. We have a variable cost of $120 and fixed cost of $725,000. And it says we're also considering upping our sales price from $160 to $170. And so it says first, hey, calculate the break-even sales in units. And so the formula for this is our fixed cost divided by our contribution margin. So if we take our fixed cost of $725,000 and we divide this by our contribution margin. So our contribution margin is going to be our selling price, which is $160, and divide it by our unit selling price, or our unit variable cost, of $120. So that means for every item we sell, we get $40 that are available for fixed cost and profit. Divide that by our fixed cost, and we get 18,125. So that means we have to sell 18,125 units to just break even. So if we sell 18,124, we lose money. If we sell 18,126, we make some money. So that's a really important number we want to keep our eye on. Okay, in part B, we want to compute the break even assuming that the selling price has increased, but all other inputs remain constant. So fixed costs are staying the same at $725,000, but our unit contribution margin is now $170 minus $120. So now we have a unit contribution margin of 50. So what that's saying is that, hey, if we increase our price $10 for every unit, we're going to lower the amount we need to sell to break even from $18,000 down to $14,500. So